All right, welcome to the Roadmap to Wealth podcast. We got a lot to discuss today. A lot of things going on in this market. Very interesting position that we're in as far as the war, what's going on with oil, how that's impacting the rest of the economy, the global economy at that, not just the U.S. And also looking at some things that we can do, possibly some moves that we can make, looking at what's going on with private credit, some Nvidia and Meta making some large announcements. So we'll get into all of that right now. Let's go. So looking at this week's results, we have the S&P down 2%, the NASDAQ down 3.2% this week, the Dow down 2%, the Russell 2000, the small cap stocks having a positive jump to 0.05%, Bitcoin down 5.9%, and we have the 10-year Treasury yield, the yield going up 0.03%. That means we have a little bit less confidence in the long-term viability of our economy when the 10-year Treasury yield increases because the price drops. So what's going on? So pretty much everybody's paying attention to oil. How is the increase in the oil price impacting everything else? So right now, the market is treating the increase in oil like a tax because it's increasing the prices of airlines, shipping, and logistics. Fertilizers is another one that's really hitting the global economy. Most of the fertilizer is produced in the Middle East. If boats can't get to where they are in the Middle East, or it's more expensive, it increases the prices of fertilizer, which means it's going to increase the prices of produce and other things that we use. Aluminum, developing economies taking a large hit, companies that are very dependent on imports, and also gas prices. We see what's going on at the pump. In Maryland right now, we're definitely above $3.90. We were at just $3 or a little bit over $3 a few months ago. So a very sharp increase, and everybody is feeling the impact. Now, the reason this is a big deal when it comes to the market is because a lot of companies are going to start feeling this. As everybody is getting squeezed, people are going to start spending less money. So a lot of discretionary income is going to be eaten up by the increase in prices, which means people are going to not take those vacations, not get those nice luxury purchases. They're going to get the necessities, but the things that are discretionary, we're going to start seeing that pull back. So this is why it's important to pay attention to, because a lot of the businesses that sell these items, that means less revenue for them and even at higher costs. So you're going to see some margins being squeezed by a lot of these publicly traded companies that are going to feel the impact of this inflation from both ends, both the supply end and also their consumers not spending as much money with them. So that's why it's important to see how this is going to turn out. Many economists and analysts are believing we're not pricing in the impact of this oil yet. The market is down, getting close to that correction territory. The S&P 500 is down 9% since from its all-time highs. The Russell 2000 is down 10%. So they actually are in the correction territory. But many economists say the blow to the global economy and U.S. economy, especially, can be more significant if the geopolitical issues between the U.S. and Iran isn't resolved shortly. Because think about it, once it's resolved, you still have a lag time between the time that ships can now start going through the Hormuz Strait versus when they're going to reach their destination and things can start flowing again. So we still have some time there. So the impact to our prices can be much more significant than what they've already been. So that's a scary thing to think about, but it's a true story. It can actually happen, and it's likely to happen as things continue to escalate over there. So last month, Nvidia hosted their GTC conference, which is turned into like the AI Super Bowl, where they have their conference, they show off all their new gadgets and gadgets, new softwares, make announcements, and even projections. And the market had a very interesting reaction this year. So over the past few years, we know Nvidia has had a meteoric rise in their stock price. So many people are invested and excited about Nvidia and how they are this AI leader right now. They kind of control the AI market with all the deals that they've announced with all these other companies and AI suppliers and users. A lot of people are excited about this company, but check this out. They announced the Vera Rubin platform. It's just going to be this supercomputer agentic AI platform, and they're projecting $1 trillion in revenue through 2027. So with this announcement, a lot of people would expect the price of Nvidia to go up because you're now doubling your revenue projections from a year ago. But what happened? That price pretty much stalled. People did not react to this news. And this is like the first big announcement that Nvidia has had in a long time where there was really no reaction. Now, why is that? That's because announcement fatigue is a real thing. Over the past few years, we're constantly hearing something positive and great about Nvidia. We're kind of getting numb to it. On top of that, the expectation for Nvidia was so high to begin with. So when they create a new great announcement, we look at the price and we say, even if you do double your revenues next year, we still have questions on the current valuation. Is it worth investing more and buying more of this stock at this high valuation? Even if you do accomplish that, the market really isn't sure. And that's one reason why the stock stayed flat through the announcement. Again, like I mentioned, they already had a historic run. So you think about all the market cap that's been added. And even before this announcement, there was questions about this valuation, like how high is too high for Nvidia? We understand that they deserve a high valuation. It's a premium company. You got to be willing to pay a premium price for it. But when is how high is too high? When is enough enough? And people have a lot of confusion about that, especially with the questions and confusion with all the significant investment in AI. Is the demand going to be there? We think there's going to be there. Of course, the people who are investing the billions in AI, they think it's going to be there, but we're not 100% sure. So that's why there's a lot of questions with that valuation now, and why I think ultimately people weren't really buying the new story where double revenues, $1 trillion through 2027 sounds good, but too many questions are already at the foundation of this AI boom. So that is why that stock pretty much stalled. So one of my favorite companies as far as investments is Meta. Meta made a huge announcement over this past few weeks where they said they are pretty much scrapping the Metaverse. Now, the Metaverse was such a big deal to this company because not only did they change their name from from Facebook to Meta to be like this leader of this new frontier to create and develop and explore the Metaverse, you're looking at about $70 to $80 billion invested into that venture. And just a few years later, I believe 4 years later, the announcement was made in 2021. So 5 years, they scrap it. Now, I think there are two valuable lessons to learn from this Meta announcement of scrapping the Metaverse, or actually three. So one is the hype around the Metaverse. Remember, people were paying millions of dollars for plots of land within the Metaverse. So people were paying money. The hype was so real about the Metaverse that people were paying so much money to own land within. Now, here's the thing about that. Here's a kind of a side lesson. You have to be careful when you're shelling out money for something that's not developed. You have to look at the true value of it, not just get hype around the excitement of the possibilities. What's the true value? Now, value comes from two things: scarcity and utility. How easy is it to create, or can I create? And yes, people can create their own kind of metaverse. I think at the time that this was announced, I think $10,000 to $15,000, you can create your own kind of metaverse platform. So why would I pay money for something that anybody can create? That's not valuable. Also, what's the real use for it? The utility for the metaverse never developed. It wasn't there. They projected it's going to be this big deal, and it turns out it was not. So that's the first thing. So much people were shelling out money for the hype. Everybody thought they was going to be rich off of NFTs in the metaverse. Did not happen. The second lesson is, even though these people are smart, even though they're great at business and they're successful, they get it wrong sometimes. They get it wrong. Nvidia recently announced that $100 billion commitment with OpenAI, scrapped it. They made the announcement and then they realized it wasn't a great idea, so they scrapped it. Just a few years ago, Apple was going to come out with an electric vehicle. They made a deal with Hyundai. They put money behind it and then they scrapped it. Sometimes they get it wrong. And here we see Zuckerberg and the crew at Meta. They got it wrong. Didn't make sense to me in the first place. There's no value there. All these people shelling out money. I remember even Nike was coming out with assets where you can buy Nike gear within the metaverse for your avatar. all this stuff. But as we see, they get it wrong sometimes. They're competing, but they're human. Okay. They're people, the board of directors, the executives, they're trying to compete. They're trying to figure out what is going to give them the edge over the competition. And again, they just got it wrong. The last lesson is this. Now, for investors into Meta, I understand how scary this was because we're seeing the capital spin of this company change. Like the fundamentals of the company were literally changing. They were putting so much cash flow into this venture that it would raise legit questions about the legitimacy of this company and the future growth and viability of this business. You really didn't know how far they were going in this new venture. So I understood people who were selling, but one lesson you have to understand: when a company is as strong as Meta in their core business, which is social media advertising, they were still number one in that space by far. So they were producing enough cash flow where they could explore, even though it was through a very expensive endeavor. They were still the number one, and they still were who they were. So investing or selling, I get it. At the same time, we saw how they rebound because they still were that cash cow. That didn't change. And it reminds me of Microsoft in the early 2010s, when a lot of investors or analysis, I should say, a lot of analysts were saying that this company was dead. And Microsoft, they put out the Microsoft Zoom, that flopped. They launched Bing, the search engine, that really didn't do much unless you use Microsoft Edge. But even if you're like me, you might use Microsoft Edge, but you're still going to Google. And then they came out with the Windows Phone. If you remember that flopped as well. And it's like, okay, this company that's known for innovation, and they're not really innovating, but just pretty much perfecting other people's inventions. If we're being honest, they keep coming out with these things and they keep falling. Even though the Microsoft Zoom MP3 player, in my opinion, was a better device than the iPod, it didn't win because the iPod and Apple had the ecosystem that was more convenient. But as far as pound for pound, the device, the Zoom was better, but it was not successful in the market. So with all that said, Microsoft Outlook and Microsoft Word and Windows was still the number one player. Everybody's using Microsoft Outlook at work, but we're saying that this company is dead because these ventures didn't work. They still were the number one in their space. They still were the cash cow. Those companies have enough room to try to innovate and try some things and fail and still be who they are. So why sell if the company is who they say they are? As far as their core business is still there. There was no threat at all. You know what I mean? So that is a lesson I think we see with Meta. And if you were to look at their stock chart, you see the dip, but you see the increase as well. So because they are who they say they were, they continue to be who that number one social media ad company. So again, I understand people selling that stock at the time, but we see that they are still who they were before the announcement, the number one social media ad company that's not being caught by anybody anytime soon. Such a large margin between them and the LinkedIn and Snapchat and everyone else. TikTok is the only company that has a chance to threaten that. But right now, that's Facebook, or Meta is still number one in that space. So we got a lot of interesting things going on in the private credit space. So what's happening with the private credit space? These are companies that lend directly. They raise money and they lend directly to either publicly traded companies like business development companies, BDCs, or private companies who are looking for alternatives to lines of credit or loans outside of traditional banks. So you have companies who will raise money, they'll raise a fund, and they will invest directly into these private credit businesses or business development companies. And then they will take the funds and invest out to a lot of these businesses. So you have a layer of the institutional layer between the company that is investing the money and the company that is actually getting the money on the credit side. And what the problem with that is, especially with the AI spending, there's a lot of visibility that I don't have as a person who is in this institution. Let's say I'm managing 401k funds or I'm managing pension funds. If I put money to a business development company and they take that money and lend it out, I'm not seeing what's exactly what's happening with those other businesses. So it's hard for me to project the success of this investment. So let's say I am a pension fund manager and I have funds to invest, and I invest in one of these business development companies. They're going to take that money and invest it out to a private company or even a publicly traded company. So there's an institutional layer between me and the people who are actually getting the money on the credit side, which means it's hard for me as a manager to determine the success or track the success of that investment because there's a layer in between. And people knew this when they were signing up with all the questions around all the AI spending, because most of this private credit is going to AI companies, infrastructure companies, or companies who are investing heavily in developing some type of AI, whether it's software or chips or a platform, whatever it is. So with all that money going in that direction is raising questions to these money managers. And here's the thing. When you look at Ares Capital and Blue Owl Capital, some of the larger companies in the private credit space, what's the use of investing into this fund when I can just invest and buy the stock? Because now the stocks are down so much with excellent dividend yields. I can invest in that. I can track where it's going. I can see the yield. I can communicate it better to the people who are trusting me with their money. Seems like a better option than just going directly to these BDC funds. And this is where the problem lies, because a lot of these private credit managers or people that are in that space who invested in it, they want their money back. But the problem on top of that, there's only a 5% withdrawal limit each quarter. And many companies are reaching that very quickly. So people aren't able to get their money back from these funds. Now, Larry Fink, the CEO of BlackRock, recently came out and said, tough, it is what it is. On the first page of the loan documents or the investment documents, you saw that you can only pull out 5% total, or only 5% total of the entire fund can come out. So it's putting a lot of people who invested in these BDCs at a position that they don't want to be in. So this is where the benefit to us comes in, because there's some people who aren't in that position. You can invest directly into these companies, or I should say, you can make the move that a lot of these pension managers or money managers want to make right now. You can invest directly into ARCC, Ares Capital, or Blue Owl. You can invest directly into those right now. Low risk, because those stocks are beaten down. High dividend yield, of course, because of the beaten down. I think Ares Capital is above 10% right now. So you have strong dividend yield coming in and at low risk. And I think this is what a lot of investors want right now, as far as low risk and some level of, I shouldn't say certainty, but I say a lower level of uncertainty. And that's what risk is, depending on the level of uncertainty around your investment. And this is what a lot of people want right now. So this is something that we can take advantage. So check out ticker symbol ARCC and OWL and see if those fit into your portfolio. So the investing tip of the week is paying attention to your portfolio for your purposes and your purposes alone. And I bring this topic up because I've seen people online recently say the 60-40 portfolio is dead, which doesn't really make sense. There's no such thing as a dead portfolio mix. Also, I'm seeing people post online. You got a lot of insurance agents who are coming up with their IULs and comparing the IULs to a 60-40 portfolio and saying, hey, this IUL that's tied to this particular index performs better than the 60-40 portfolio, which also doesn't really make sense to compare the two, because when you look at different portfolios and different investment vehicles, they all are going to have their separate risk profile. Now, if I have a separate risk profile for this portfolio, that means I'm acknowledging a different expected outcome for that. So to say this one is great and this one is bad doesn't really make sense. So now when it comes to the 60-40 portfolio, we're talking about 60% in stocks or equities and 40% in fixed income. Typically bonds is what people are historically have used for that stock versus bonds portfolio mix. And the 60 portfolio isn't dead. It just makes sense for certain people. So here's the number one person that makes sense for. Somebody who has retirement funds and they're close to retirement, and now they need to de-risk their portfolio because within a few short years, they are depending on money to be there. And they don't want too much money exposed to the market where you can suffer a sequence of returns risk. Now, when I say sequence of returns, imagine this. It's 2007, 2008. I entered the workforce after college, and I'm talking to some people who are still working, who plan on retiring, but they had so much of their portfolio exposed to the market in the year 2000 hit, and a lot of their portfolio got wiped out. Would have been smart for them to have a 60-40 split or something to where so much of their portfolio isn't at risk in the market and they can draw on that money that they needed to retire and leave some of that money invested, giving it time to recover from that downturn. Imagine some of those same people who left money in the market in 2008 when that crash hit. So I remember 2012, I'm still working with people who planned on retiring in 2008 or 2009, but they couldn't because of what happened with the market. Even recently, I'm working with somebody who planned on retiring in 2022, but that was a heavy year in the market. So the man was nervous. He had enough money saved up, but he was so nervous. Like, what if this happens again in 23? And what if this happens again in 24? I'm not going to be too happy about leaving the workforce right now if that happens. Now, he went ahead and at the end, I think the beginning of 2023, he went ahead and retired. But think about that uncertainty and that worry when you're at that age, when you want to retire or need to retire, but the market is down so much and you're like, what should I do? Here's what you should do before you get to that point. You probably want to look at a 60-40 split or something that de-risk your portfolio to the point where you're comfortable. And within the next 3 to 5 years, the money that you know you're going to need is outside of the market in bonds, which means it's virtually there's no risk. It's extremely low risk because the United States has never defaulted on their bonds. Of course, that's because they print money, but that's another issue. But this is why a 60-40 split or any portfolio mix for that matter isn't dead. It's not a statement that makes sense. It's not very intelligent to analyze a portfolio that way. Also, a 60-40 split could be great for somebody who maybe you're risk averse. Now, understand this is not going to give you the maximum gains in the market. And maximum gains in the market is not something that everybody should be shooting for. Not everybody is a hedge fund manager. So why is that your goal? You should have money invested in the market that's invested in a way that you're comfortable, that allows you to sleep at night, that's going to get you to your financial goals. That's why I say your portfolio is for you and you alone, is for your goals, no one else's expectations. So once you develop that, and if a 60-40 is going to get you there, maybe it makes sense to be there and not risk or adding risk to your portfolio that might not get you there because of the risk. When there's risk, that means that portfolio could be down or the market could be down to an extent where you can't reach your goals if you're at a 90-10. So maybe a 60-40 makes sense, especially for people who might inherit some money. You might be a younger investor, you inherit some money. Maybe a 60-40 makes sense just in case you know you're risk averse and you know you're going to start selling as soon as that market dips in a major way. Maybe you need to be able to look at your portfolio and see money that's not impacted by the market, that's still earning you some yield, keeping up with inflation, so you're not losing buying power, to the point where it allows you to grow and to get to the point where you are comfortable with more risk. Because let's be honest, not everybody is there. I don't care if you've been investing just now or if you've been investing 20 years, some people are just risk averse and that's their nature. And they could still be invested in a way where they can reach their goals. So being risk averse is not the end of the world. Sometimes we need time to get comfortable with the risk before we start investing in individual stocks or taking on more risk. So be mindful to not listen to some of the horrible takes and advice. A 60-40 split or whatever portfolio mix is designed for you and your comfort. So a 60-40 is not dead, just might not be the best investment portfolio mix for everyone, but there's no portfolio that's dead. There's some that just might not fit you and your risk profile. So keep that in mind. All right. So this has been the Roadmap to Wealth podcast. I appreciate you joining me, and I'll see you next week.